Over the next 1 to 2 weeks, we could see one of the most important volatility windows for XRP and the broader crypto market in 2026. And if you are not mentally prepared, you are going to react emotionally instead of strategically. That is exactly how retail traders lose money. Welcome back to We Are Cosmic, where we break down crypto, macroeconomics, and global finance like professionals, not gamblers. If you are serious about understanding what is really moving the markets and positioning yourself ahead of the crowd, you are in the right place. Right now, there are two massive forces building pressure in the system. First, we have President Donald Trump announcing a global tariff increase from 10% to 15%. Second, we have rising geopolitical tension between the United States and Iran with nuclear negotiations back in focus. When you combine trade wars and military uncertainty, you create volatility, and volatility is where smart money makes its moves. Now here's something interesting. Jim Cramer recently came out publicly and said investors should be bearish on Bitcoin and cryptocurrencies. Historically, when he becomes extremely bearish at peak fear moments, markets are often near local bottoms. Even Elon Musk joked about this phenomenon, sometimes referred to as the Cramer Index. I am not saying we blindly trade against media personalities. That would be reckless. But when mainstream financial voices turn aggressively negative at the same time macro pressure builds, that is when experienced traders start watching for reversal signals, not panic selling. Let's talk reality. Trade tariff increases create short-term fear in global markets. Investors worry about inflation, supply chain disruptions, and slower economic growth. Risk assets like crypto usually react with initial downside pressure. We have seen this pattern multiple times before. The market drops fast, liquidations happen, fear spreads on social media, and then, once uncertainty begins to settle, capital rotates back in aggressively. The same pattern often happens with geopolitical conflict. When tensions rise between major nations, Bitcoin and altcoins frequently experience sharp declines. But historically, once escalation fears calm or negotiations progress, the rebound can be just as violent as the drop. This is why the next 1 to 2 weeks matter. Trump's new 15% global tariff policy is scheduled to activate very soon. Markets have not fully reacted yet. That does not mean nothing will happen. It simply means participants are waiting to see how other countries respond. Retaliatory tariffs, trade negotiations, or political statements could trigger the real volatility wave. At the same time, Iran nuclear discussions are ongoing. If talks collapse, we could see risk-off sentiment spike quickly. If negotiations show progress, markets could breathe relief. Either way, uncertainty creates movement. As a professional analyst, I want you focused on preparation, not prediction. We do not control headlines. We control our strategy. Here is what I believe is developing: a short-term correction window followed by a powerful rebound opportunity. When both trade tension and geopolitical stress hit simultaneously, markets often overreact. That overreaction is where disciplined traders look for structured entries. But let me be very clear, this is not financial advice, this is strategic awareness. Most retail traders wait for confirmation from news outlets. Professionals anticipate volatility zones in advance. Mark the calendar, watch liquidity levels, track Bitcoin dominance, monitor XRP reaction to macro headlines. The market has not panicked yet, but historically, delayed reactions are common when policy shifts are involved. On We Are Cosmic, we do not chase pumps. We analyze pressure points. And right now, pressure is building. When President Donald Trump previously announced tariffs during earlier trade escalations, markets reacted in a very specific pattern. It did not matter whether the tariff was 5%, 10%, or targeted at a single country. The reaction sequence was almost always the same: initial fear, sharp sell-off, liquidation cascade, stabilization, then aggressive rebound. This pattern is not random. It is structural. When tariffs increase, investors immediately think about three things: inflation, slower growth, and reduced global trade efficiency. Traditional markets begin pricing in risk. When traditional markets fall, high-risk assets like crypto usually get hit first. That is because institutions treat crypto as a liquidity source. If they need to reduce exposure, they often trim digital assets quickly. But here is what most retail traders misunderstand. The first move is emotional. The second move is calculated. The emotional move is the dump. The calculated move is the accumulation that follows. In previous tariff cycles, Bitcoin and altcoins initially dropped anywhere between 8% to 20% within days of major announcements. Social media turned extremely bearish. Influencers predicted deeper crashes. Fear peaked. And then, once markets absorbed the news and realized the world was not ending, capital rotated back in. Why does that rebound happen? Because tariffs, while disruptive, do not permanently destroy economic systems overnight. They create negotiation pressure. Markets hate uncertainty. Once uncertainty becomes measurable, volatility decreases and risk appetite slowly returns. Now let's connect this directly to XRP. XRP historically reacts strongly to macro liquidity shifts. When global uncertainty spikes, XRP often follows Bitcoin downward in the short term. But when relief rallies begin, XRP can outperform because it attracts speculative momentum capital quickly. This is especially true when narratives around banking, cross-border settlement, or institutional adoption are circulating in the background. Right now, we have a 15% global tariff increase on the table. Markets have not fully priced in retaliatory measures yet. If other major economies respond aggressively, we could see a coordinated risk-off move. That would likely trigger leveraged long liquidations across crypto derivatives markets. Liquidations amplify volatility. When long positions are forced to close, price drops accelerate quickly. This creates panic. But once excessive leverage is flushed out, the market becomes healthier and more stable for a rebound. That is the key insight. Corrections caused by policy shocks are often liquidity resets, not structural bear market confirmations. Now, does this mean we ignore risk? Absolutely not. The biggest mistake traders make is assuming every dip is automatically a buying opportunity. Timing matters, structure matters, confirmation matters. If we do see a decline triggered by tariffs activating around February 24th, I would expect a fast drop, not a slow bleed. Heavy liquidation volume, social media fear spikes, followed by stabilization within days to 2 weeks. Remember, markets move faster now than they did 5 years ago. Information spreads instantly. Reactions compress into shorter time frames. Another important factor is positioning. Many traders are already cautious because geopolitical tension is high. That means we might not see as dramatic of a crash as previous cycles, because some fear is already priced in. But here is where it gets interesting. If tariffs and geopolitical tension overlap, fear could stack. And stacked fear often produces exaggerated moves. That exaggeration is what experienced traders prepare for. We are not hoping for a crash. We are preparing for volatility. There is a big difference. And if history repeats even partially, any tariff-driven decline could be followed by a strong relief rally once negotiations stabilize. Now that we have broken down the impact of tariffs, it's time to shift our focus to the second major driver of potential crypto volatility, the ongoing US-Iran tension. This is not just political drama. It has real implications for markets, especially for risk assets like Bitcoin and XRP. Recently, negotiations in Geneva regarding Iran's nuclear program have hit a stalemate. Iran has dismissed proposals to relocate nuclear material abroad and continues enrichment activities, while the U.S., under the Trump administration, is applying intense pressure with a tight 10-15 day timeline. From a market perspective, this uncertainty is critical. Geopolitical tension creates fear, which drives short-term liquidations in crypto markets. Traders often react faster than traditional investors because crypto is highly liquid and operates 24/7. Historically, when geopolitical risks escalate, Bitcoin tends to be the first to move. Investors often use it as a hedge or liquidity source, not necessarily a safe haven. XRP, on the other hand, is more sensitive to sudden spikes in leverage and speculative flows. Why? XRP is highly traded on derivatives exchanges, meaning any shock in sentiment can trigger cascading liquidations very quickly. But let's be clear, this does not mean you should panic. Markets often overreact to headlines. Initial drops caused by geopolitical fear are usually sharper than the underlying economic reality justifies. After the panic subsides, relief rallies often occur, sometimes very aggressively. This is where strategic traders can position themselves for outsized gains. Think back to previous US-Iran conflicts or tensions in the Middle East. In each instance, crypto markets experienced a fast initial drop followed by stabilization within a week or two, and then a strong rebound once the geopolitical risk became more predictable. This is exactly the type of pattern we can anticipate now, especially with both the tariff shock and the Iran situation overlapping. Timing is critical. Trump's 15% global tariffs are expected to activate around February 24th, while the Iran nuclear negotiations could see developments within the same 10-15 day window. This overlap creates a high-risk, high-opportunity period for traders. Being aware of these timelines is essential. Traders who react emotionally to the first headlines often miss the real move, the strategic entry after initial liquidations, but before the rebound. Another key factor is market sentiment. Right now, fear is building but has not peaked. Social media sentiment analysis, derivatives, open interest, and trading volumes all indicate that most retail traders are cautious but not fully hedged. This creates a window for disciplined traders who understand macro dynamics to enter positions at attractive levels. Finally, remember that geopolitical shocks are temporary catalysts, not permanent value destroyers. They influence sentiment, liquidity, and short-term price action, but the fundamental narratives around crypto adoption, banking partnerships, and institutional flows remain intact. XRP, for example, is well positioned for institutional use cases that are independent of these geopolitical shocks. Now that we've analyzed both the trade tariff situation and the US-Iran tension, let's combine these factors to understand how they interact and what this means for XRP and the broader crypto market. We are entering a very specific window of market pressure. Tariffs are set to increase globally to 15% around February 24th, while the Iran negotiations have a short 10-15 day timeline. When you overlay these two catalysts, you have a convergence of risk that could trigger short-term volatility spikes. Timing is everything. Traders who understand these overlapping pressures can position themselves before the majority reacts emotionally. Historically, whenever macroeconomic shocks and geopolitical tensions happen simultaneously, we see a pattern, a sharp initial decline followed by a strong rebound. The first phase, the decline, is fueled by fear, liquidations, and speculative selling. Social media amplifies this fear, creating a self-reinforcing cycle. But experienced traders recognize that this is temporary. Once initial panic passes and more clarity emerges, capital flows back into crypto, often at levels much higher than before the dip. Let's break this down step by step. Step 1, initial reaction. When tariffs officially activate and geopolitical headlines spike, expect Bitcoin and XRP to dip quickly. This is the first wave of liquidations. Retail traders panic, stop losses trigger, and leverage positions unwind. Step 2, market stabilization. After the initial sell-off, smart money begins to evaluate the situation. Retaliatory tariffs, negotiation progress, and real economic impact are considered. The market stabilizes as volatility subsides temporarily. Step 3, strategic rebound. Once stabilization occurs, relief rallies begin. This is where XRP often outperforms due to speculative interest and institutional positioning. Traders who prepared for this window can enter strategically and ride the rebound for substantial gains. An important point to note, the magnitude of the correction depends on market sentiment leading up to February 24th. Right now, fear is building, but not extreme. That means the initial drop could be sharp, but relatively short-lived. Historical examples suggest that corrections triggered by trade wars or geopolitical tension last anywhere from a few days to 2 weeks, depending on the severity of the news and liquidity conditions. Another key factor is leverage. XRP, like other crypto assets, has a high percentage of positions held on margin. When large-scale liquidations happen, price moves faster than normal market conditions. That's why timing and risk management are critical. Traders must avoid emotional decisions and focus on structured entry and exit levels. Let's talk strategy. For the next 1 to 2 weeks, monitoring these two catalysts closely is vital. February 24th, tariff activation. This is the official date when global markets may react sharply. Iran negotiation updates. Any news of progress or escalation could trigger additional volatility. Being aware of these events in real time allows you to plan entries, manage risk, and avoid panic selling. It's about positioning yourself in advance instead of reacting after the fact. Finally, remember the broader perspective. While short-term volatility is high, the long-term narratives around crypto adoption, blockchain integration with financial institutions, and XRP's role in cross-border payments remain unchanged. These structural factors mean that dips caused by temporary macro or geopolitical shocks can be excellent entry points for strategic traders. Now that we understand the timing and mechanics of this high-pressure window, with tariffs and geopolitical tension overlapping, it's time to discuss actionable strategies for traders. This is where preparation turns into opportunity. First, let's talk risk management. When volatility spikes, positions can move against you very quickly. The initial reaction to tariffs or geopolitical headlines could trigger sudden drops in Bitcoin and XRP of 8 to 15% within hours. If you are over-leveraged, this can wipe out your position. Professional traders always use controlled trade sizes and stop-loss levels. This is not about avoiding risk completely. It's about managing it intelligently. Second, we must monitor liquidity and leverage. XRP has a high proportion of positions held on margin. When liquidations start, the market moves fast. This is a double-edged sword. On one hand, it can exacerbate drops. On the other hand, it provides opportunities for structured entries. Look for moments when fear peaks, high liquidations, sharp price drops, and extreme sentiment indicators to position strategically for rebounds. Third, consider entry windows. Based on historical patterns, Phase 1, panic dip. This is the first few days after major news hits. Retail traders panic, liquidation spike. Experienced traders often wait for this wave to crest before entering. Phase 2, stabilization. After the initial drop, prices begin to level off. Volume decreases and social media fear begins to fade. This is a critical window to analyze technical levels and confirm that the panic is over. Phase 3, relief rally. Once stabilization occurs, the rebound begins. This is when smart money rotates back into XRP and other cryptocurrencies. Entry here can yield significant upside if timed correctly. It's important to combine macro awareness with technical analysis. While headlines tell us about potential catalysts, chart patterns reveal actual market behavior. Look for support zones where previous dips have stabilized, check derivative markets for high leverage clusters, and watch Bitcoin dominance as a leading indicator of altcoin behavior. Now let's talk strategy tiers for traders with different risk tolerance. Conservative traders focus on small, structured positions. Wait for the market to stabilize before adding. Use strict stop losses and avoid chasing the panic dip. Your goal is preservation with moderate upside. Aggressive traders identify liquidations and panic zones early, position for a rebound immediately after the first wave of selling, be ready to scale out during the relief rally. This strategy carries higher risk, but also higher reward. Another critical point is timeline discipline. With tariffs activating around February 24th and Iran negotiations running concurrently, this window of high volatility is expected to last 1 to 2 weeks. Do not overstay positions or hold through unmanageable risk. The goal is to capitalize on structural moves, not gamble on headlines. Lastly, remember that psychology matters. Most retail traders will panic, sell at the lows, or FOMO into the rebound. Professionals stay calm, observe, and act based on evidence. Emotional discipline separates winners from losers in this environment. We've covered a lot so far: tariffs, geopolitical tension, historical market reactions, and tactical strategies. Now it's time to tie everything together into a professional action plan for the next 1 to 2 weeks. This is your roadmap to navigate this high volatility window like a pro. Step 1, mark the critical dates. The first key date is February 24th, when the 15% global tariffs are scheduled to activate. This is likely to trigger the initial reaction in crypto markets, especially XRP and Bitcoin. The second key window is the ongoing Iran nuclear negotiations, which have a tight 10-15 day timeline. Any updates, either escalation or progress, could move the markets sharply. Keeping a calendar of these events allows you to anticipate volatility instead of reacting emotionally. Step 2, monitor market sentiment. Social media, news outlets, and derivative metrics are essential tools. Fear spikes during panic liquidations. When sentiment reaches extremes, it often signals a short-term bottom. Conversely, overly bullish sentiment after relief rallies can indicate overextension. Combine these observations with historical patterns to find strategic entry and exit points. Step 3, risk management. Position size and leverage are critical. Never risk more than you are willing to lose. During high volatility periods, small, controlled positions allow you to ride swings without catastrophic losses. Always use stop-loss levels and plan exit points before entering trades. This ensures you stay disciplined even when headlines are moving the market. Step 4, identify entry zones based on historical behavior. Expect initial panic. Dip, a fast drop triggered by tariffs and geopolitical headlines. This is often emotional selling by retail traders. Stabilization zone, after the panic, prices level off. Observe technical support, volume, and leverage metrics here to confirm the bottom. Relief rally, once stabilization occurs, capital rotates back into crypto. This is where structured entries yield maximum upside. Step 5, adapt your strategy to your risk profile. Conservative traders focus on small positions after the stabilization phase. Prioritize capital preservation and moderate gains. Aggressive traders target the panic dip and scale into the relief rally. Be ready to exit as momentum peaks. This carries higher risk but can result in greater returns if executed properly. Step 6, keep perspective on fundamentals. While short-term volatility can be intense, long-term narratives remain intact. XRP continues to develop real-world use cases in cross-border payments and banking adoption. Temporary shocks do not erase the structural growth potential. By maintaining this perspective, you avoid making reactive decisions that hurt your portfolio. Step 7. Prepare mentally and technically. High volatility windows test both your strategy and your discipline. Plan trades, review charts, track macro events, and ensure you are not chasing hype. Professional trading is about observation, preparation, and execution, not emotion-driven decisions. Step 8. Stay informed. Subscribe to channels like We Are Cosmic for structured professional-level analysis. Real-time updates and context help you interpret market moves rather than react blindly. Understanding the why behind market moves is what separates professional traders from the crowd. In summary, the next 1 to 2 weeks are a potential turning point for crypto. The combination of Trump's tariffs and Iran negotiations creates a short-term window of high volatility. By monitoring sentiment, controlling risk, timing entries, and maintaining perspective, you position yourself to navigate this environment professionally. Remember, this is not about chasing pumps or headlines. This is about strategic awareness, preparation, and execution, the principles that consistently produce results in crypto markets. Stick to the roadmap, focus on risk-adjusted opportunities, and use the volatility as a stepping stone toward building a stronger, smarter crypto portfolio. At We Are Cosmic, we equip you with this kind of insight so that when the market moves, you move with it, not after it. Stay prepared, stay disciplined, and use these next 2 weeks to sharpen your trading edge.